The last topic in Chapter 13 focuses on the idea of contingencies in accounting. So let's look at the actual definition. A contingency is when there's an existing condition, situation, or set of circumstances involving uncertainty as to possible gain or loss to an enterprise that will ultimately be resolved when one or more future events occur or fail to occur. We've actually seen this previously in this course, at the intermediate level when we were looking at bad debt expense. Bad debt expense is actually a loss contingency, because at the time that we loan, and extend credit to a customer, we really don't know if they're going to pay us in the future or not. It's contingent on that future event. So again, when the time that the sale actually occurs and we receive an account receivable, we don't really know if we're going to collect that account receivable. It's contingent on future events, whether we collect or we don't collect. So that makes it a loss contingency. So we estimate bad debt expense, if it's probable that we will have bad debts, and we can estimate it. So it had to meet those two conditions before we actually made the debit and credit journal entry. Well, let's look at specific rules for contingencies. If it's a gain contingency, that would be an example of, let's say we're in the middle of a lawsuit and the outcome looks favorable to us. It looks like we're going to win and likely collect some money. That would be a gain contingency, that we're actually going to gain on the situation. So at the balance sheet date, we do not record the gain contingency. Again, this rule is consistent with accounting and the concept of conservative. Accountants are conservative. We'll recognize losses early on, but we don't recognize gains until they actually happen. And that's the issue here. We're not actually going to record the gain contingency until it actually happens. However, we might disclose that information in the notes to the financial statements when there's a good probability that exists for realizing them. And let's review that word realize. Remember, there's two common R words in accounting, if you will. One is to recognize an event. To recognize something is to report it in the financial statements. The other R word, if you will, is to realize something, and that means we're going to receive cash. So we will disclose gain contingencies when it's probable that they're going to occur, and we anticipate realizing those in cash. Okay, so gain contingencies don't get too much of the accountant's attention because we don't do much with them other than disclose them, and not always disclose them. It's only if it's probable that we will disclose them. A loss contingency, on the other hand, is more likely to be accrued or reported. So we will report or accrue a loss contingency if both of the following two conditions are met. One is that information available prior to the issuance of the financial statements indicates that it is probable, or that it is probably probable, see I misspelled that a liability has been incurred at the financial statement date. Now that takes some reviewing here. So let's review. Here's our financial statement date, 12/31/X1. But, if this is a time chart, the financial statements may, here's the end of the year, but the financial statements may not actually be released until 3/1 or March 1 of the next year. So that's what it's talking about. In between this time period, between here's the balance sheet date and here's when we actually issue our financial statements, if something happens here where we know that we can go back and look, okay, it's probable then at this point in time that the loss is going to occur. And it could be, what happened here is that the lawsuit was settled. And, in somewhat of an unfavorable way for us. So we lost it, but we settled. So it could be something like that happened before the balance sheet was issued. And so we know that on the balance sheet date that, we were going to lose, or we probably were going to lose, whichever way you want to look at it. And so then we want to accrue the loss for the balance sheet and the income statement at 12/31/X1. Okay, so again, this involves judgment and it's subjective, right? So it's a really gray area in accounting because no two accountants might precisely agree on the criterion. But here are the guidelines that the FASB has given us. So again, it has to be probable. So it's probable that a future event is likely to occur, we accrue it. However, if it's reasonably possible, that means that it's more likely than it's the future event is more than remote, but it's less than likely, then we do not accrue. So we do not accrue in that situation, we just leave it alone. Or if it's remote that we're going to have a loss, then we don't do anything else as well. So those are the guidelines, but again, it gets down to judgment, whether, I view it as probable, reasonably possible, or remote. That's rather judgmental. So if it meets the criteria of probable, then we will accrue it. But it also has to meet the second criteria, because it has to meet both of these. Secondly, we have to be able to estimate it reasonably. So, and also, if we're only able to arrive at a range, like we may say $1 to $1.5 million, if we only are able to arrive at a range, then here's what you do. You use the best estimate within the range, maybe 1 million, or maybe 1.2 million, or if that's not known, just use the low end of the range. In that case, in my example, if we were having a range from 1 to 1.5 million, we would go with the 1 million on the low end. Okay, so we will accrue if criterion 1 and 2 are both met. Now, if one is met and the other one is not, then we will disclose it in the notes to the financial statements. Okay, well, let's move on and look at some examples. In addition to estimated bad debt expense, what other kind of loss contingencies face a company? So exercise 11 looks at warranties. Warranties at the time of the sale, again, we're going to have sale revenue. At the time of the sale, we may likely, if it's a product, issue a warranty for that product. So we want to be able to match warranty expense with the sales revenue. And the only way of doing that, just like bad debt expense, is to estimate it. Because we don't know at the time of the sale how many of those items, those goods, are going to come back under warranty. Okay, so here we have an example, or an exercise. So Cheryl Crow Company sold 500 Roll-O-Matics during 2014 at $6,000 each. During that year, she spent $20,000 servicing the 2-year warranties. All applicable transactions are on a cash basis. Okay, so let's prepare the entries. So first we're going to record the sale. So that's pretty easy. Debit cash, credit sales revenue. And let's see, that was for 500. Let's see, so 500 of these sold at $6,000 each. It's going to be $3 million. Okay, so let's record $3 million. Okay, then she's also spent at that time $20,000 on the warranties. So here's the cash payment. So let's go ahead and record the cash payments. So we're going to go ahead and debit warranty expense. And cash will go out for that $20,000. Okay, now probably there's more to that $3 million that's going to come back, of those sales, that's going to come back under warranty. So we want to accrue an additional amount. And again, this is going to be based on our estimate. And they go ahead and give us the estimate. They estimate a total of $120,000 will come back under warranty. Now we've already recorded $20,000 of that, so we just need to record another $100,000 for warranty expense. Okay, and once we do that, in the warranty expense account, we'll have the total estimate. So our total estimate is $120,000, and we got that by recording actual, and then at the year end, So this would be 12/31/2014. So at year end, recording that additional expense. Okay, now what am I going to credit? So we debited warranty expense. Well, we haven't paid it. If we haven't paid it, then it's a liability. So warranty liability. $100,000. Okay, now the second part of this is the same sort of scenario, except we're going to assume that of the $3 million of sales, $150,000 of that is applied to warranties. And this is an example of when you go in and buy something, maybe like at Best Buy, you not only buy the merchandise, but you have the option of purchasing a warranty for it. So this is when we actually had sales revenue. If I take $3 million minus that $150,000, I'll get $2,850,000. So the sales of the product were $2,850,000, and we're also going to have sales revenue for the warranty. Okay, so we'll have sales for the warranty. Now, and cash will come in of $3 million. So if we look up above, again, we're getting $3 million, same thing. The difference is that it's broken out between the two components. $2,850,000 applies to the sales of the merchandise. $150,000 applies to the sale of the warranty. But here's going to be the catch. We haven't earned this yet. We haven't earned the $150,000. The $150,000 is going to be earned right over this 2-year period. So at the time of the sale, we haven't earned it, so that means it's unearned. So we'll have unearned warranty liability, or unearned warranty revenue, if you will, but it is a liability. So unearned revenue for the warranty, and again, that is a liability, just to remind you. Okay, let's go to the next page and see what we need to record. Okay, well, going back, remember in the scenario that we had $20,000 was paid out. So we are going to have the cash payment for warranty expense. $20,000. So let's just remind ourselves that we spent $20,000 for those warranties. And then just a reminder that of the $20,000, that is out of $120,000 estimate for the total. So we're about 16.67% complete on this warranty. We're about that far along on the completion. So what we want to do, instead of recognizing this revenue, this unearned warranty revenue, instead of recognizing that revenue over time, we're going to recognize it based on completion. So we're 20 out of 120, or 16% along. So we're going to take that times our unearned warranty revenue of $150,000, and it looks like we have earned $25,000 of revenue. So we're going to reduce unearned warranty revenue and record warranty revenue. Okay, and so this year there would have been sales. Let's go back and get that figure. $2,850,000. We would have had also warranty revenue of this $25,000. And then we would total those. So on the income statement, we'd have sales revenue, warranty revenue. When I go down to the expenses, we would also have warranty expense of this $20,000. And again, I'm not putting it in a correct format for the income statement. I'm just saying, here's the two revenues that would get reported, here's the expense that would be reported. And again, notice the difference. Under the other method where the warranty was not something the company sold, we had an additional expense of $100,000. So as to match revenue and expense. So in the first one, we had sales revenue, $3 million. And then we matched that with this $120,000 of warranty expense. Again, so we recognize the full warranty expense in the first year, even though it takes place over two, in order to match, in order to meet the matching principle, match revenue with expenses. So we recognize the full $120,000. Whereas over here, it is based on completion. So here's our warranty contract. Here's how much we've earned. Of the $25,000 earned, here has been the expense for that. Okay, moving on to exercise 2 then. We have No Doubt Company includes 1 coupon in each box of soap powder that it packs, and 10 coupons can be redeemed for a premium. And the premium is a kitchen utensil. So if a customer turns in 2 coupons, they can get receive a kitchen utensil. Okay, so No Doubt Company purchased 8,800 premiums, which would be 8,800 utensils at 80 cents each, and then sold 110,000 boxes of soap at $3.30. Okay, so then we've got 44,000 coupons presented for redemption. The company estimates 60% of the coupons will be redeemed. Well, let's go through this. First off, we want to record the purchase of these kitchen utensils. So we're going to have an inventory of premiums. Again, the premiums are the kitchen utensils. So $7,040. And then cash would be paid out. And again, that is that 8,800 kitchen utensils at 80 cents each, $7,040. Okay, then we're going to record sales. So, cash comes in, we record sales revenue. And that is selling 110,000 boxes of soap. So 110,000 boxes. Whoop. And then at $3.30 each. So $363,000. Okay, so we just have record the purchase of the kitchen utilities, and then record the sale. Okay, the next thing we're going to want to solve for is going to have to do with those coupons. So we want to look at the expense of those coupons. So let's see, we actually have 44,000 coupons were presented. So let's see, 44,000 coupons. And let's see, it takes 10 of those to get a utensil. So 44,000 coupons, divide by 10, that means we issued 4,400 kitchen utensils, or premiums, if you will. So 4,400 utensils were issued. Then we need to go back. Our cost were 80 cents each. So our actual cost for what we gave out, $3,520. So again, I want to review this concept. If we put the utensils in at 80 cents to our inventory account, if we put it in at 80 cents, then we need to take it out at 80 cents. So if we put cost in at 80 cents, we need to take cost out at 80 cents. So that's what we're going to do. Let's go over and record the reduction of that inventory for $3,520. So the inventory of premiums will go down. So we credit that to reduce it, and then that's our premium expense. Okay, so here is what we actually paid out. So here's what we actually gave up. But now we want a full, we want to match sales with the premium expense in the same accounting period. So if we recorded, sales of $363,000, we want to fully match that. What's the full cost of the premiums that we anticipate? So of these sales, how much of that is going to come back that we need to issue kitchen utensils for? Okay, so let's go back and look at the information to arrive at the estimate. They estimate that 60% of the coupons will come back or be redeemed. So of the 110,000 coupons, right, we sold this many boxes, so there's only one coupon in each box. So there's 110,000 boxes, which is 110,000 coupons. And our estimate is 60% will come back. Okay, so that is 66,000 coupons are going to be redeemed. Okay, 66,000 coupons that are going to be redeemed. And so, if I divide that by 10, that means we have 6,600 premiums or utensils that we're going to be issuing out. Okay, and then those cost 80 cents each. I believe at 80 cents. So 5,280 is our total premium expense. So there's our, and that is an estimate. So our estimated premium expense is going to be 5,280, and I put a minus sign because expenses are subtracted from sales. Okay, so that needs to be the total expense. And if I look at premium expense right now, we have $35.20 in the account. We want the account to have a balance of 5,280. So I need to increase it $1,760. So we're going to make, we're going to accrue an additional amount for an estimate. So for our additional amount to get the full estimate, we will debit premium expense, an additional $1,760. And then we haven't issued those yet, so it's going to be a liability. Premium liability. And then we'll have a perfect matching of revenue and its related expense. Okay, let's move to exercise 13. And this is 3 cases, and we're just going to look at those to see, these are contingencies. Do we accrue these and report them on the balance sheet, or does it get disclosed, or do we do nothing? So what are the 3 possibilities? So this gives us an opportunity to really apply those concepts discussed earlier. All right, so during 2014, Salt and Pepper became involved in a tax dispute. The attorneys believe it is probable that Salt and Pepper will lose this dispute. They also believe they have to pay the IRS between $900,000 and $1.4 million. After the financial statements were issued, the case was settled with the IRS for $1.2 million. What amount, if any, should be reported as the liability? Okay, well, first off, it looks like they have a loss contingency. So it's not a gain contingency, it's a loss contingency. So we have a loss contingency here. Second question is, do we accrue it? Well, in order to accrue it, you have to meet 2 criteria. One is that it's probable. So it is. So our attorneys are telling us it's probable that we're going to incur this loss. And secondly, can we reasonably estimate it? Well, at the balance sheet date, there is an estimate between $900,000 and $1.4 million. So it meets both of those criterion. It's probable and we can estimate it. So because of that, we're going to accrue this liability on the financial statement. So we'll debit some sort of loss and we'll credit a liability like lawsuit payable or something like that. So we'll debit a loss and credit a liability account. Now, what amount are we going to accrue? We have this range. We also have this $1.2 million in the case. But notice, we don't know about the $1.2 million until after the financial statements were issued. So actually, that's kind of irrelevant information. We had to know, as accountants, when those financial statements were issued, what is the estimate going to be? We don't know actual on the date that we issue the financial statement. So we didn't know about the $1.2 million, so that's going to be kind of irrelevant to our decision. So then that brings us back to the range, the $900,000 to the $1.4. Now the case doesn't give us a most likely dollar amount within that range. Since it doesn't give us a most likely dollar amount within the range, we will go with the low end. So here's what our case solution will look like. So the FASB requires that when some amount within their range of an expected loss appears at the time to be a better estimate, to accrue that. But we don't have that. This is not happening in our scenario. So here's us. When no amount within the range is a better estimate, use the low end. So in this particular case, they're going to report a liability and debit a loss for $900,000. Okay? Let's go on to the next one. On October 1, Jackson Chemical was identified as a potentially responsible party by the Environmental Protection Agency. Jackson's management, along with the council, have concluded that it is probable, so there's one of our criteria has been met, it's probable that Jackson will be responsible for the damages. A reasonable estimate can be made, so that's our second criterion. So we've got both criterion met. And they are estimating $5 million. Jackson's insurance policy of $9 million has a deductible clause of $500,000. So how should Jackson report this information on its financial statements? Now, in this particular case, the author of this case said we would accrue the full $5 million. And that the $500,000 is a gain contingency, so we would not accrue it. So that's the author's solution. I think you would find accountants who might argue different than that and would accrue 4.5. Instead of $5 million, 4.5 million. And again, there's a good example of differences in perspectives of reading the FASB's codification in those statements issued by the FASB. Anyhow, the bottom line is it's probable, we can reasonably estimate it, so accrue that loss with the liability for the financial statements. Okay, the last one. I'll let you read through that and let's talk about it. Okay, in this case, they're going to receive less than the fair value, but more than the book value. If you receive more than book value, you have a gain. You know, if cash, you're debiting cash, crediting your book value, your debit to cash exceeds the credit, you need another credit to balance, that's going to be a gain. So this is actually a gain contingency. Gain contingencies, we don't do anything. So because the amount to be received is less than the book value, it's a gain contingency. Again, think about it. You're debiting cash, you're crediting your various book value, you need another credit to balance, that would be a gain. Okay, and then they don't really tell us about probability here. If this was probable, then we would disclose that in the notes. Okay, so there we have gone over loss and gain contingencies and how to record those, report those, or ignore those in the financial statements.